Specialty chemical maker Rossari Biotech's 496 crore rupees IPO had a stellar listing today. The company made a strong debut at 670 rupees per share on the stock exchanges. Let's do a 3-point analysis to find out what should investors do after this sharp surge. 1. A bumper listing. Rossari Biotech made a solid debut as the stock prices got listed at a 58% premium over the issue price at 670 rupees per share when you compare it with the issue price of 425 rupees per share. Now, the listing price was much higher than the grey market premium of around 180 rupees over the issue price as well. The IPO had got a phenomenal response. It was subscribed over 79 times as well, largely backed by the qualified institutional buyers and HNIs whose reserved portion was subscribed 85 times and 240 times respectively, while the retail portion was subscribed over 7 times. Now, experts say that the company's wide variety of customer ranging offerings from FMCG to apparel to poultry and animal feed industries to even companies that make home and personal care products is one of the reasons that made the IPO a big hit. 2. What's the growth outlook for the company going forward then? Well, the company is among the largest manufacturers of textile specialty chemicals in India. It also manufactures the disinfectants and sanitizers for which the demand outlook is robust in the current scenario. Also, overall, the company offers 2030 different products in 18 countries and has 2 R&D facilities. That's one within the Silvassa manufacturing facility and the second one is in Mumbai. Now, the company has reduced its dependency on the textile space while simultaneously the revenue share of home and personal care segment or this division has also increased, and currently it accounts nearly 47% of the FY20 revenue, which is a big positive for Rossari Biotech as well. Now, in the past 3 years, that's FY17 to FY20, the company has delivered stupendous growth on the revenue front, which grew at CAGR of 42%, EBITDA which grew at 57%, and net profit that surged by 60%. Experts believe the robust performance should continue even going forward from here. The company is financially sound with low leverage in the balance sheet and will use the net proceeds from the issue for working capital requirements as well as for pairing some kind of debt that the company had availed earlier. Also, for general corporate purposes, the funds will also be used. 3. Should one exit with the listing gains or should one really stay put for the long term is the big question. Well, most of the analysts believe that Rossari will command a premium over the chemical peers that it has right now because it is net free, has better asset turnover, working capital days, even return on equity and return on the capital employed or the ROCE. Experts, however, say that investors with moderate risk appetite could use the listing gains and also book profit right now, while the high risk investors can hold on for long term.